Bank of America is it's riding just a massive wave right
Oh,
now.
absolutely massive.
Yeah, I mean the stock is up over 13% in just a single month. It's this relentless climb and it's heading straight into tomorrow's earnings report.
Right.
But, there is this really glaring contradiction hidden in the data. While the stock is shooting up, key corporate insiders are quietly cashing out.
Which is always a red flag.
Right. It leaves you with this really critical question, like, is this stock a screaming buy, or are retail investors about to step into just a massive value trap?
Well, you are looking at the absolute definition of a market crossroads here.
Yeah.
I mean, this incredible bullish momentum is colliding head-on with some very stark underlying fundamental risks. The numbers coming out tomorrow are going to be a huge catalyst.
Sure.
But the current trading environment is it's deeply polarized.
Which is exactly why we're doing this deep dive today. We are tearing down the financials, the technicals, and frankly, the wildly conflicting valuations floating around Wall Street today, April 14th, 2026. Because tomorrow morning, Bank of America ticker symbol BAC drops its Q1 earnings. And we want to make sure you're fully equipped to understand the mechanisms driving this stock before that opening bell even rings.
Because, I mean, once those numbers hit the wire, the market reaction is going to be instantaneous.
I'll blink and you'll miss it.
Exactly. Understanding the structural setup today is really the only way to cut through the noise and, make sense of the chaos tomorrow.
Totally. Now, before we unpack all these conflicting models, if you are getting value out of our deep dives into Wall Street's biggest earnings traps, make sure you like the video and subscribe to our YouTube channel.
Please do.
And it is compulsory that you leave us comments and feedback. Seriously, we want to know what you think. Are you buying BAC tomorrow, or are you staying far, far away?
Let us know.
We use your feedback to figure out which tickers to tear down next. So, okay, I want to start by looking at the raw financial engine here.
Let's do it.
We need to establish a baseline of what Bank of America is actually doing before we can even debate what it's worth. So walk us through the latest balance sheet as of today.
Sure. So today, BAC is trading at $53 flat.
Okay.
That's up 0.88% for the session. And we've seen a daily range between 51.85 and 53.44.
Which is pretty tight.
It is. But zooming out, that puts the stock comfortably near the top of its 52-week range.
Right, because the low was what, mid-30s?
Yeah, the low sits at 26.27, and the absolute peak is 57.55.
Man, so it's brushing right up against its yearly ceiling right now.
It really is. And, the scale of the operation behind that stock price is just staggering. If you look at the trailing 12 months, the TTM total revenue sits at a massive $113.0 billion.
Wow, over $113 billion.
Yeah. And out of that top line, their net income is $29.06 billion.
Which is great.
It is. It represents roughly a 13% increase year over year.
Okay, so the profitability is clearly expanding. What does that look like on a per-share basis?
So earnings per share, or EPS, sits at $3.78.
Got it.
And they also pay out an annual dividend of $1.12, which gives you a yield of about 2.10% at the current $53 price tag.
Okay, pretty solid yield. And what about the valuation multiples?
So the PE ratio, the price to earnings, is 14.10 based on the last 12 months. But interestingly, the forward PE drops a bit to 12.27.
Okay, I always find that gap between trailing and forward PE really fascinating.
Yeah, it tells a story.
It does. For anyone trying to wrap their head around it, that drop to 12.27 essentially means analysts expect Bank of America's earnings to grow over the next year.
Exactly.
Like, the market isn't just paying for past performance, it's paying for future potential, which naturally makes the stock look slightly cheaper on a forward-looking basis.
That's the exact mechanism at play. Wall Street models are they're baking in continued profitability growth.
Right. But, okay, looking at the rest of these metrics, I have to point out this glaring number on the balance sheet.
The debt.
The debt-to-equity ratio.
Mm-hmm.
It's sitting at this eye-watering 232.96%.
Yeah, it looks scary.
It does. I mean, I know banks operate differently than, say, tech companies, but to a regular person, carrying debt that is more than double your equity sounds like a financial emergency.
Sure.
In the current macroeconomic environment, is this just the cost of doing business for a massive bank, or is this an actual crack in the foundation?
Well, to understand that 232% figure, we really have to look at how banking completely inverts our normal understanding of corporate debt.
Okay, how so?
Well, if a software company carried that much debt, institutional investors would flee immediately.
Oh, 100%.
But for a bank, your deposits, the money you put in your checking account, those are classified as their liabilities.
Oh, because they owe you that money back.
Exactly. The core mechanism of their business is taking that massive pool of liabilities, that quote-unquote debt, and lending it out via mortgages, auto loans, corporate lines of credit.
And they do that at a higher interest rate than what they pay you for your deposit.
Right. The spread between what they pay depositors and what they charge borrowers is their actual product.
Gotcha.
And, I mean, that spread is what generated that $29 billion in net income we just talked about.
Okay, so that high leverage ratio isn't necessarily a distress signal. It's just the engine running the way it's supposed to run.
Exactly. It's designed that way.
Yeah.
However, your point about the macroeconomic environment is definitely crucial.
Because of interest rates.
Yes.
Yeah.
Because they are so highly leveraged, any sudden shift in interest rates or, loan defaults ripples through their balance sheet much faster than it would a traditional company.
Which perfectly explains why institutional investors get so skittish and why the technical charts matter so much right now.
Oh, absolutely.
I mean, a highly leveraged entity requires constant momentum to sustain a premium valuation. So, let's look at how the market is actually trading this today, because we just came off an 8-day winning streak.
Yeah, 8 consecutive days of green closes. The stock is in a very, very strong technical uptrend.
So for anyone watching the opening bell tomorrow, what are the specific algorithmic levels they need to be aware of?
Okay, on the downside, your first layer of support is at 51.50. That aligns with the short-term 5-day moving average.
Okay, so that's the psychological floor where short-term traders might, step back in and buy.
Right, but the more critical safety net is lower, sitting at $50.50.
Why there?
Because that is where the 50-day and 200-day moving averages currently converge. And moving averages aren't just invisible lines on a chart, they are active triggers.
Right, the algos use them.
Exactly. Institutional trading algorithms are often programmed to just buy automatically when a stock hits its 50-day moving average.
Fascinating. And if it drops below that?
Below that, you've got stronger algorithmic support sitting at 48.70, which is the 20-day average.
Okay, but what about the upside? Like, if earnings beat expectations tomorrow and this momentum actually holds?
Immediate resistance is sitting right above today's price at 53.50.
Okay.
If buying volume breaks through that level tomorrow morning, the ultimate technical ceiling is that 52-week high we mentioned.
The 57.55.
Exactly.
But the tension here is that after an 8-day run, the buying pressure has to be nearing exhaustion, right? I mean, this is where momentum indicators usually start flashing warning signs.
Oh, they are definitely flashing right now. We look at 2 primary indicators here. First, the NAVT, the moving average convergence divergence.
And that's sitting at what?
It's at 0.54. So the MACD basically looks at the relationship between short-term and long-term moving averages to gauge if momentum is accelerating or slowing down.
Right.
At 0.54, it actually still shows positive trend strength.
But the second indicator paints a completely different picture, doesn't it?
Yeah, the RSI, the relative strength index, is the one causing anxiety right now.
Because it measures the speed and change of price movements, right?
Exactly, on a scale of 0 to 100. It basically tracks how fast a stock is rising relative to its recent history. And right now, BAC's RSI is at 67.24.
Wow. And traditionally, anything over 70 signals that a stock is overbought.
Right.
Meaning the buying pressure has kind of outpaced the actual value creation, and a pullback is statistically likely.
Exactly. So at 67.24, it is officially categorized as neutral, but I mean, it is dangerously close to that exhaustion threshold.
So a lot of the enthusiasm for tomorrow's earnings is probably already mathematically baked into the current price.
Very likely, yes.
Which raises a really fascinating question about who is actually doing all this buying.
Oh, the order flow data is wild here.
Right, because it shows that smart money, like institutional funds and large asset managers, they drove this 13.4% monthly rally.
Yep.
And retail investor participation is heavily elevated too. But I caught this massive discrepancy in the insider data.
The executives.
Yeah. While institutions were buying heavily, multiple corporate officers, specifically Bernard Mensa, Thomas Scribner, and James DeMar, were actively selling off shares in March.
Yeah, the divergence between institutional buying and insider selling is it's one of the most hotly debated signals in finance.
And look, I understand that executives sell stock for mundane reasons. Tax obligations, diversifying their portfolios, maybe buying a house.
Sure, happens all the time.
But we have three high-level officers taking profits in the exact same month, right after a 13% run and right before a critical earnings report.
It's suspicious.
They are taking risk off the table just as the RSI approaches that overbought territory. I mean, are retail traders blindly following institutional momentum right into a peak that the actual insiders are fleeing?
I mean, you really cannot ignore the timing here. Insider sales, especially when they're clustered like this, they often signal that management believes the stock is currently fully valued.
Right.
Or at least that the risk-to-reward ratio has skewed negative in the short term. I mean, these executives see the exact same RSI we do.
Plus, they see the internal banking metrics before anyone else.
Exactly. This tension between institutional momentum and executive profit-taking is really the root of the valuation debate that's tearing Wall Street apart right now.
Okay, let's dig into that valuation debate. Because analysts are looking at the exact same financial snapshot we just discussed, and they're coming away with wildly different conclusions.
It's a massive split.
We have the undervalued gem camp on one side and the dangerous value trap camp on the other, but it seems like the bulls have the sheer weight of numbers on their side right now.
They do. The consensus is overwhelmingly bullish. Currently, 92.65% of analysts covering the stock rate at a buy.
Over 92%.
Yeah. Only 7.35% say hold, and there are actually 0 formal sell ratings from major institutions.
That's crazy. And what's their price target?
The consensus price target is $59.15, so that implies about a 12.5% upside from here.
And the high targets.
The most optimistic targets even have it reaching $71.
Okay. And the primary metric anchoring all that optimism is tangible book value.
Yes.
I want to spend a second here because I know this is calculated very differently for banks than for other sectors.
It is.
Basically, if you were to liquidate Bank of America today, sell all the physical real estate, call in every single loan, pay off that massive debt pile we talked about, and you strip away any intangible assets like goodwill or the brand value.
Which is huge for BAC.
Right. But strip all that away, and what you have left is the tangible book value. And right now, Bank of America trades at a multiple of 1.9 times that value.
Which is key. To put that in perspective, the industry average for their banking peers right now is 3.1 times tangible book value.
Wow.
So compared to its direct competitors, the underlying physical and financial assets of Bank of America look incredibly cheap.
Okay.
When you run intrinsic financial models based on that deep discount, many analysts mathematically arrive at a fair value comfortably over $60.
Okay, so it's a very compelling argument based on pure asset accumulation.
Right.
But the bears have a very sharp counter-argument, and they are calling this stock a classic value trap.
Yeah, the bearish argument basically completely dismisses the balance sheet and focuses entirely on the income statement and the multiples.
Okay, break that down.
So we noted earlier the PE ratio is 14.10. While the tangible book value is cheap compared to peers, the PE ratio is actually trading at a premium.
Oh, because the peer average PE is only, what, 11.6?
Exactly, 11.6x.
So you are literally paying more for every single dollar of earnings than you would at competing banks.
Exactly. And furthermore, when you look at strict cash flow models, the picture gets even darker. There is this narrative fair value model currently circulating that ignores historical balance sheet assets entirely. It looks purely at the cash the business is actively generating today.
And what does that model say?
Based strictly on current cash flows, this model suggests the stock is only worth $43.34.
Whoa, that is a staggering discrepancy. Trading at $53 today, but valued at $43.34 by cash flow metrics.
Yeah.
That means the stock could be anywhere from 16% to 23% overvalued right now, depending on which model you trust.
The models are literally fighting each other. One values the sheer size of the vault. The other values how fast money is actually coming into the vault.
I think the best way to synthesize this for you listening is to look at it kind of like a rental property.
Oh, that's a good analogy.
Right. Imagine you are evaluating this massive apartment building. If you look at the raw land, the bricks, the copper wiring inside the walls, the tangible book value, it looks like an absolute steal compared to the building next door.
You're getting the physical materials at a huge discount.
Exactly, a classic value play. But if you look at the actual rent checks coming in every single month from the tenants, the cash flow, and you compare that income to the asking price, you realize the yield is terrible.
Right. you might actually be overpaying by 20% for that income stream.
Yes. You have an asset that is physically cheap, but cash flow expensive. No wonder people are so confused.
That analogy perfectly illustrates the mechanics of a value trap. A stock looks cheap on paper because of historical asset accumulation, right? It lures in retail investors who think they found a bargain.
Yep.
But because the underlying cash generation isn't strong enough to justify the actual price, the stock never breaks out. It just stagnates or slowly bleeds out over time.
I'm looking at these short-term and long-term forecasts, and honestly, I'm having trouble reconciling them.
It's tough.
Because tomorrow's earnings look like a surefire win for the bulls, but this long-term outlook feels like a slow-motion trap. How are you weighing these two radically different scenarios?
Wh-
Like, what is the catalyst that proves the bulls right tomorrow, and what is the hidden risk that proves the bears right in the long run?
Okay, let's take the short term first. The immediate short-term catalyst is strictly tomorrow's Q1 2026 earnings report.
All right.
The Wall Street consensus expects them to post 99 cents in earnings per share on $29.64 billion in quarterly revenue.
So those are the baseline hurdles the company absolutely has to clear.
Exactly. But the metric professional traders are watching closely is the earnings ESP, the expected surprise prediction.
The ESP.
Right. The ESP is this specialized metric that compares the most recent up-to-date analyst estimates against the older, broader consensus. It tries to capture late-breaking sentiment.
And what's it saying right now?
Right now, the ESP suggests Bank of America will likely beat those EPS estimates by somewhere between plus 0.74% and plus 1.49%.
And a beat tomorrow wouldn't even be an anomaly. It would be their fifth consecutive quarter of beating Wall Street estimates.
Exactly.
Yeah.
And this is the best-case recovery scenario for the bulls.
Okay.
If management comes out tomorrow, beats the 99-cent EPS, demonstrates strong revenue growth, and issues really confident forward guidance, that provides the necessary volume to blast through that 53.50 resistance and make a serious run toward that 57.55 peak.
Man. But the long-term bears, they aren't looking at tomorrow's EPS beat at all, are they? They are looking at structural decay.
Precisely.
Yeah.
The most significant structural weight dragging down Bank of America's long-term potential is their portfolio of low-yield HTM securities.
HTM, which stands for held to maturity.
Yes.
Let's explain the mechanics of how this actually traps capital, because it's important.
It's super important. So several years ago, when interest rates were incredibly low, Bank of America bought billions of dollars in long-term U.S. government bonds and mortgage-backed securities.
And these were paying around, what, 1.5 to 2%?
Roughly, yeah.
Yeah.
Very low yield. And they designated these assets as held to maturity, signaling an intent to hold them for 10 to 30 years.
Okay, and because of that specific accounting designation, they don't have to report the massive unrealized losses on those bonds as long as they don't sell them.
Right. The accounting rules sort of shield the balance sheet, but they don't fix the underlying economic reality.
Because now we are in an environment where interest rates are significantly higher.
Exactly. Newly issued bonds are paying 4 or 5%. But Bank of America has billions of dollars in capital trapped in those old 2% bonds.
Right, so they are earning this tiny yield on their assets while simultaneously being forced to pay much higher interest rates to depositors just to keep that money from fleeing to, like, higher yield savings accounts elsewhere.
And you've just described the exact mechanism of margin compression.
Wow.
It is a slow, invisible drag squeezing their profitability from the inside out. They can't sell the bonds without taking a massive, highly publicized loss, so they just have to suffer the lower yield for years.
That sounds miserable for long-term growth.
It is. And add to that the fact that the broader banking sector has issued higher than expected expense guidance for 2026.
Meaning staffing, technology, regulatory costs, they're all going up.
Yep, all rising. So the long-term cash flow picture gets incredibly murky.
So if management even hints at margin compression tomorrow on the call, the reaction will be brutal.
Oh, swift and brutal.
I mean, even if they beat earnings slightly, if they sound panicked about rising expenses or that HTM drag, the market algos are going to reject that 53.50 resistance level instantly.
Absolutely. We could see a rapid fall straight back to that 48.70 support level.
But let me push back on the significance of the HTM portfolio for a second.
Sure.
If they have a proven history of consistent earnings beats, aggressive stock buybacks, and they have a solid 2% dividend yield, does a long-term HTM drag really matter to someone who is just trading the momentum today?
Honestly.
Yeah.
It entirely depends on your time horizon and your strategy.
Okay.
If you are a momentum trader looking to capitalize on tomorrow's post-earnings volatility, the HTM drag is basically just background noise.
Right, you don't care.
You're just trading the psychological reaction to the EPS surprise. But if you are a long-term investor looking to buy and hold BAC, that slow margin compression is everything.
It's the whole ball game.
It really is. It is the defining difference between a stock that aggressively compounds wealth over a decade and a value trap that just stagnates for 5 years while inflation eats your returns.
You really have to know what game you are playing before you sit down at the table. Are you playing the short-term earnings pop, or are you buying the long-term business fundamentals?
Exactly. Because right now, the technical momentum and the fundamental valuations are telling two very, very different stories.
And tomorrow morning, we get the next major chapter.
We do.
Let's summarize this setup as you prep for the opening bell. Bank of America is riding incredible institutional momentum, up over 13% in a month. They have solid core profitability, pulling in $29 billion in net income, and the earnings ESP strongly points to an impending earnings beat tomorrow.
And the stock looks cheap on a tangible book value basis.
Exactly. But you must weigh that against the fundamental warning signs. Corporate officers were actively selling shares as the RSI approached overbought territory.
Which is huge.
Strict cash flow valuation models suggest the stock might be overvalued by up to 23%. And you have severe macroeconomic banking headwinds, specifically the trapped capital in that low-yield HTM bond portfolio that's dragging down their long-term margins.
It's a lot to weigh.
It is. And as always, this deep dive is an analysis of the available data, the market mechanics, and the conflicting arguments on Wall Street. This is not financial advice, and we are not telling you to buy or sell.
We never do.
We are simply giving you the x-ray of the patient before the earnings report drops tomorrow.
And it is going to be a highly volatile and revealing morning, that's for sure.
I want to leave you with a final kind of provocative thought to mull over tonight.
Okay.
We know the earnings ESP predicts Bank of America will beat expectations tomorrow. Let's assume they do. Let's assume the headline numbers are absolutely fantastic.
Okay. Best case scenario.
If they crush earnings tomorrow, but the stock price still drops or fails to break resistance, what does that tell you about how much of this good news was already priced in during this 8-day winning streak?
Ooh, that's the real question.
Right. Sometimes the market buys the rumor and aggressively sells the news. Keep a very, very close eye on the volume at the opening bell.
Because the market's reaction to good news is often way more telling than the news itself.
Perfectly said. Thank you so much for diving deep with us today. Remember to subscribe and drop your predictions in the comments. We will catch you on the next one.